Hey, what is going on, everybody? I hope you are doing well. In today's video, we're going to be talking about how to remove mortgage insurance without having to refinance. So I actually got a call today from a friend of mine, and he was asking me about the different options to remove the mortgage insurance from his existing conventional loan. And obviously, he did not want to refinance because about 2 years ago, he completed a refi and the rate was under 3%. And as of today, the property value is worth substantially more than it was 2 years ago, but the interest rates have gone up so much. So refinancing was not an option. Anyway, if you are in the same situation, so if you've either purchased or refinanced within the last 1 to 3 years, using a conventional loan and you currently have mortgage insurance on that loan, then this video is something that you're going to want to pay attention to. Now, before we jump into the details, if you wouldn't mind hitting that like button, hitting that subscribe button if you're new to the channel and you like all things finance, real estate, and investing. And without further ado, let's jump right to it. Okay, so believe it or not, this is actually a relatively simple process. There are two ways that you can remove mortgage insurance on an existing conventional loan. The first is that your loan balance needs to be paid down to 78% of the original value when you either purchased or refinanced. So up on the screen, I have a calculator. I'm going to walk you through a very basic example. So let's say you originally refinanced and or purchased, and at the time you did so, the appraised value was approximately $400,000. So you would take the original value and you would multiply that by 0.78, which is 78% of that value, and it would give you a balance of $312,000. Now, your loan balance would need to be paid down to $312,000 or lower for the lender or servicer to automatically remove the mortgage insurance that is associated with that loan. Now, let's say you put 5% down a couple years ago, or maybe 10% down. It may take you several years if you just pay the minimum monthly payment to get that mortgage insurance removed. So that process can be, and generally is, very, very slow. So is there a faster way? The answer is yes, and it does not require a refinance. All right, so let's go ahead and run through another example. Let's say that you owe $400,000. That's your current loan balance as of today. If you've purchased in the last 1 to 3 years, then odds are you have more equity now than you did when you originally bought that property. So the way to figure out the value that you would actually need to remove the mortgage insurance is you would take your loan balance and then you would actually divide it by 0.78. Okay, that would give you an estimated value of $513,000 roughly. In other words, if you were able to get the property to appraise for $513,000 or higher, then the mortgage insurance could be removed. With that said, there is a very specific way to do that. You would actually need to go directly through your mortgage servicer as opposed to contacting your loan officer or contacting an outside appraisal service. So you would call up your mortgage servicer, just look for the contact information for their customer service line on the mortgage statement itself. Call them directly, let them know that you would like to petition to have your mortgage insurance removed. Make sure you are very clear that you are not interested in refinancing. A lot of times their customer service reps like to loop you back to a loan officer to look at refinance options. Well, if your rate currently is under, let's say, 3.5% or 4%, then refinancing today most likely will not make any sense. So you would contact their customer service, petition to have it removed. They would actually conduct an appraisal that is at your expense, and we'll talk about that here in a minute. And if the value came in at $513,000 or higher, they will actually remove that mortgage insurance for you. And if you're paying, $100 a month or $150 a month in mortgage insurance, well, then, that's a $1,200 to $1,800 per year saving. Now, the risk that you take is that you have to actually pay for the appraisal. So how do you mitigate that risk? How do you determine whether or not the value of the property is actually there and this makes sense to give it a go or give it a try to see if you can get that removed? Well, the first thing that you do is jump over to the internet. You're going to want to plug your address into a couple different systems just to get an idea of what that home might be worth. Now, you can call a loan officer or real estate agent to help you with this, but it's very easy just to do some quick research online. So I'm going to go ahead and jump over to Zillow. I looked up Sacramento, and I'm just going to pick a house at random here. So let's say this is your house. Let's go ahead and copy the address, and I want to go ahead and get an idea of what this value might be worth. So if you go into Google and you search Chase Home Value Estimator, you can pull up this search tool, and then you can go ahead and just copy and paste the address, hit search. Property is worth about $721,000. If you bump over to Zillow, it says it's worth about $810,000 there. You can see that highlighted. And if you go over to even Redfin, I generally recommend that you check a couple of these sites just to get an idea, maybe take an average. And then the Redfin estimate here is $775,000. So between the three sites, you have 720, 775, and 810. So it's probably safe to say that this home is worth somewhere around 750,000, and that would give you a good baseline. So you take your property and run it through this exact example and try to figure out what is your home worth. Now, if you have a little bit of wiggle room there, let me bump over to the calculator. So if you owe $400,000 and you find out that your house is worth, let's say, $700,000, you know that you have a ton of wiggle room there, and it's absolutely worth trying to have that mortgage insurance removed with your servicer, because you know that as long as it appraises at 513 or higher, then that mortgage insurance will go away. Full disclosure, you should contact the mortgage servicer. Some of them have very specific requirements. Some of them have a seasoning period where they're like, hey, you have to be in this loan for at least 1 to 2 years, or if it's less than that, you have to show that you've done substantial improvements to that property to warrant that higher valuation. But either way, this is something that is worthwhile pursuing. Again, somebody that has purchased or refinanced with a conventional loan over the last 1 to 3 years and is still paying mortgage insurance. Anyway, I hope you found the information useful and valuable. If you did, please hit that thumbs up, subscribe if you are new to the channel, and leave a comment below. We'd love to hear from you. Thank you so much. Take care.